The Australian government just made a massive expansion to the 5% deposit scheme. And if you've been sitting on the sidelines thinking homeownership is years away, this could change everything. I'm Jack Chen from Brilliant Finance Group. I've been a mortgage broker for 8 years, settled over 450 million in loans, and I've helped hundreds of first-home buyers get into their first property. Here's what we're covering today. First, I'll show you the real numbers with and without the scheme. Then what actually changed in October 2025 and why it matters. And finally, I'll walk you through what you should consider before jumping in and whether this scheme actually makes sense for you. Let's get into it. All right, let's start with what the 5% deposit scheme actually is. It's a government program that lets eligible first home buyers purchase a property with just a 5% deposit and avoid paying lenders' mortgage insurance, which we call LMI. Now, why does this matter? Normally, if you have less than a 20% deposit, banks will charge you LMI. This is insurance that protects the lender, not you. If you can't make your repayments, the bank will see you as a higher risk because you have less equity in the property. So they make you pay for insurance that covers them.
And it's not cheap.
We're talking 20,000 to 30,000 or more, depending on your loan size. I'll give you an example. Let's say you want to buy a 800,000 property in Victoria. With stamp duty, mortgage registration, and transfer fees, you're looking at a total cost of about 845,000. Now, if you have the savings and go to the traditional 20% deposit route, your upfront cost will be around 205,000. The loan will be around 640,000, and because you won't be paying any LMI, your monthly repayments will be around 3,600. If you only have 5% deposit saved up without access to any government incentives, your loan breakdown will look something like this. Around 109,000 in upfront costs, a loan value of 760,000, which includes an LMI of 24,000. You're looking at a monthly repayment of 4,500. Now, with the deposit scheme, you can see the LMI cost is reduced and you bring your monthly repayment down by around $200. So with the scheme, you save over 120,000 in upfront cash compared to the 20% deposit, and you avoid 24,000 insurances compared to the regular 5% deposit. Now, this scheme has actually been around since 2020, but it had major limitations that locked out most people, and that's what's changed in October 2025. There were actually 3 major changes. Number 1, unlimited access. There used to be a cap of 35,000 spots per year. Even if you qualified, you might miss out just because the spots ran out. That's completely gone now. Number 2, income caps were removed. Singles used to be capped at around 125,000, couples at 200,000. So if you earned more, you are no longer eligible. Those limits are completely removed as well. And number 3, property price caps massively increased. The old caps were so low that in Sydney, Melbourne, Brisbane, you couldn't buy anything decent in the areas first home buyers actually wanted to live. Now the caps reflect real market prices. For Sydney, it's increased to 1.5 million. Melbourne and Brisbane have increased to 950,000 and 1 million respectively. And the cap in Adelaide is now 700,000. So what does this all mean for you? If you were previously shut out because you earned too much, or because the properties in your areas were above the old price cap, you are potentially back in the game. But you need to tick some eligibility boxes. So who's actually eligible for this? First, you're an Australian citizen or permanent resident over 18. Second, you're buying a property to live in as owner-occupied. This isn't for investors. Third, you haven't owned properties in Australia or it's been at least 10 years since you did. Fourth, you've saved at least 5% deposit. And fifth, you can apply on your own or with the other person, whether that's a partner, sibling, or even a friend. Now, before you get too excited, I do have to mention that the reality of making it easier for more people to buy is that demand goes up. And when demand goes up, so do prices. Think about it like this. The old scheme had 35,000 spots per year. Now it's unlimited. The income caps that's locked out thousands of buyers are gone. The property prices that force people to look in outer suburbs are now realistically for where people actually want to live. What that means is that you've suddenly got tens of thousands more buyers competing for the same properties, more buyers at auctions, more property are inspecting the same homes, and more offers on every listing. And sellers knows this. They're watching the same news as you are. They know there's more buyers in the market now, so they're holding out for higher prices. CoreLogic just released data showing housing values are rising at the fastest pace in more than 2 years. Now, I'm not saying this to pressure you. I'm saying this because I've watched this happen before. When the government makes buying easier, there's a window where you benefit from the access before prices fully adjust. But that window closes fast. So if you're eligible and you're serious about buying, don't sit on the sidelines thinking you'll wait 6 months to save for a bit more. In 6 months, you might need an extra 50,000 just to buy the same property. Having said that though, there are some things you need to consider if you are going to use the scheme to buy your first home. The first is that you're borrowing 95% of the property's value. That means you're starting with only 5% equity. If the property price dropped even 10%, you could find yourself in a negative equity where you owe more than your home is worth. This means you can't sell without bringing cash to the settlement, and you can't refinance to a better rate. Second, your repayments are high because you're borrowing more. Your monthly repayments are significantly higher than if you had a 20% deposit. Using our 800,000 example from earlier, you saw that with 5% deposit and the scheme, you're going to be paying around 4,300 per month instead of the 3,600 if you had paid a full 20% deposit. That's an extra $700 per month. Third, there's always interest rate risks. Right now, rates are around 6%. If they go up to 7 or 8%, your repayments will jump dramatically. The bank assesses you with a buffer, but life can change. So you need to make sure that you can afford the higher repayments. Fourth, you must live in the property. The scheme is owner-occupied only. If your situation changes, you'll need to speak to your bank to ensure that there are no penalties. Now, I'm not telling you this to talk you out of it. For the right person in the right situation, this scheme is genuinely powerful. It's helped hundreds of my clients get into homes they wouldn't have been able to afford otherwise. But you need to know what you're signing up for so you can make the right call. So to wrap up, the 5% deposit scheme lets you buy properties years sooner than saving for a 20% deposit. You avoid $20,000 to $30,000 in lender's mortgage insurance, and you get into the market while you can still afford it. But it requires discipline, realistic expectations, and proper planning. If you watch this video and you're thinking,
okay, Jack, I get it,
but I still don't know where I personally stand, here's what to do next. Book a free strategy call with me. The link's in the description. Otherwise, I'll see you in the next one.